Hello, and welcome to the Dhaka Frontier webinar, Outlook for South Asia 2021. I'm Ravin Krishan, Client Relationship Manager for Asia Pacific at Dhaka Frontier. Before we get started, we realize that some of you may be new to our company. So we'd like to take a minute to provide you with a very quick overview of our firm and how we work with executives at major multinationals. Dhaka Frontier is a leading market intelligence and consulting firm that provides tailored solutions to drive growth for clients across the consumer, B2B, healthcare, and technology sectors. Our dedicated teams serve as advisors to clients, delivering the market and industry knowledge they need to succeed at all points in the business cycle. With continuous research and insights, custom solutions, and transaction support services, we provide our clients a small sample of which you can see here, with timely, actionable insights to adapt and win in changing markets. Our company is headquartered in Washington, D.C., with offices in Troy, Michigan, New York, London, Paris, Berlin, Singapore, Shanghai, and Bangalore. As part of our offering, we're excited to announce that we have recently launched a new mobile app. FrontierView Mobile, which is available for both iOS and Android, includes all the relevant content you need to monitor markets, inform strategic planning, and power key decisions in your critical markets. Having briefly introduced our company and plugged our mobile app, I'd like to take a moment to briefly introduce our presenter for today. On the line for today's webinar, we have our analyst for South Asia, Kinnari Gurnani. Kinnari supports senior executives on key initiatives, including strategic planning, resource allocation, and risk management for their South Asia portfolio. If there are any insights you see today as part of this discussion, or any questions we don't get to answer, our client services team, Sarah, Althea, Yuchen, and I will be happy to follow up with you directly. And with that, I'd like to turn things over now to Kinnari to take us through our agenda.
Thanks, Ravin. Our webinar today will consist of a 50-minute presentation, followed by a session of Q&A. To be specific, I will begin the session with a discussion on our underlying assumptions behind the COVID-19 outbreak globally and how India and Pakistan are performing relative to their peers in the Asia-Pacific region. We'll then do a deep dive into the economic outlook for India, the impact the pandemic has had on growth, and how different industry segments and states are likely to recover over the next 12 to 18 months. We'll then discuss the outlook for Pakistan, highlighting the impact of the outbreak on its economy and what recovery looks like. Finally, we will round out the webinar with a Q&A session. So if you have any questions or points of clarification regarding any of the topics that we cover today, please do not hesitate to send them to Dhaka Frontier Webinars via the GoToMeeting Messenger by clicking on the Q&A box on the right-hand side of your screen. And we'll do our best to ensure that they are addressed in the Q&A period. So without further ado, let's get started. Now, we'll begin by laying out our three assumptions for the COVID-19 outbreak globally. First, the widespread COVID-19 vaccination is not expected to be available until late 2021. Second, until this time, secondary outbreaks will continue to emerge across the various countries over the globe. And finally, as a result of these secondary outbreaks, several restrictions will also remain until the vaccination or widespread vaccination is in place. So this is what the outbreak and its management has broadly looked like across the world. Now, this framework that you see on the slide here has been adapted from a framework by Thomas Pueyo called The Hammer and the Dance. What this really is anywhere between days and weeks of the first outbreak in any country broadly, several governments around the world almost simultaneously clamped down with stringent restrictions on the movement of people and goods. This is the hammer that you see in the dotted blue line. For some countries, this proved largely effective, which allowed governments to lift restrictions in a phased manner. For other countries, the extreme toll that the strict lockdown took on the economy caused the government to in fact start lifting restrictions even as case numbers raged on. As time passes, until a vaccine or effective treatment is mass produced, we expect secondary outbreaks to continue emerging around the world. The government will do a dance of sorts by lifting and placing restrictions in response to some of these secondary outbreaks. Now, this is what the actual first and second wave outbreaks look like in the Asian context. We are now in the midst of a second wave of outbreaks, but the composition of this wave has dramatically changed. What you see here are the daily active number of cases. So those are the total cases minus recoveries minus deaths. While China contributed the most to the first wave in the region, India has now exceeded those numbers by a very large margin, as you can see there in the dark blue area. The Indian government imposed one of the strictest and longest lockdowns globally between April and June. But they have gradually lifted restrictions due to the heavy toll on the economy, highlighting this fine balance that some governments have had to take between the lives versus livelihoods debate. Now, Pakistan, on the other hand, did see a sharp rise in case counts around the Eid period, but is now reporting very limited new cases every day. And as we'll see through the coming slides, this divergence in the pattern of outbreaks has actually led to a divergent view or outlook for these two economies as well over the next 12 to 18 months. Now, these are our forecasts for the different Asian economies for 2020 and 21. India, as you can see, and very much leading in from what we saw earlier, will see the sharpest fall in growth, while other countries that have handled the pandemic relatively well, and in fact whose governments have provided substantial stimulus to individuals and businesses to support this recovery, are going to perform much better. So these are the countries that you see more on the right-hand side of this graph. Pakistan will suffer a short-term contraction in 2020, but is expected to in fact grow next year. Now, evaluating the relative growth rates of the different Asian markets is actually valuable for some of the clients who have more of a broader Asia-Pacific portfolio to pressure test assumptions across the various country teams, which can also support certain internal prioritization exercises. Now, after providing this broader APAC context, let's dive deep into the assumptions for India's economy. Now, as I've said, we expect India's economy to contract sharply. This is going to be about 11.5% contraction in the year 2020, followed by kind of a recovery of growth rate in 2021, and then a normalization of growth in 2022. Some of the basic assumptions that basically underlie our growth expectations from India are the consistent rise in the number of cases despite that very stringent 2-month-long lockdown, and a relatively muted government stimulus. So both of these together, we are expecting to have significant economic ramifications. Now, over and above those very basic underlying assumptions lie some of our drivers of overall growth. So as you can see here on the right-hand side, we're expecting a negative impact from overall investment, consumer spending, as well as exports. However, in terms of government actions, we are expecting kind of a neutral response to or an impact to the overall economy. What government actions really means here is in terms of the overall government stimulus, and we'll take you through why we consider that as a muted or limited and insufficient response. And second is in terms of additional lockdowns that the government is going to have. Now, in this extremely unprecedented global pandemic scenario, ideally, we would have liked the government actions to provide a positive impact on overall growth. But here, in comparison to that, all we are seeing is a neutral impact. We continue to watch three things that are going to continue to drive our forecasts that we revise every month. The three things here that we're watching for the Indian economy are the spread of the COVID-19 outbreak, levels of various local lockdowns or the dance that the Indian government is likely to do, and finally, any additional government stimulus measures over and above what they've already provided. Now, this is what some of those quarterly numbers look like. What we just saw were annual numbers. This is what some of the quarterly numbers look like. One thing that I would certainly like to highlight here is that India's financial year of 2020 runs from April 2020 to March 2021. And so what you're really seeing is throughout that financial year 2020, we are going to continue to see contractions of growth, particularly as it pertains to 2019. And so there should be no surprise here really, because we are certainly expecting a much muted level of economic activity in 2020-21 as compared to 2019. The latest numbers of overall GDP growth that we have are the April to June numbers here that you see that showcase that the Indian economy actually contracted by a very, very large extent. That was a negative 24% contraction in overall GDP in the quarter that just passed. Now you see here that there are sharp spikes, positive spikes in numbers in the April to June 2021 period. But I would like to provide a disclaimer here that that actually does not reflect an expectation of a recovery in overall economic activity, but rather the result of the base effects that we saw in that April to June 2020 period. This is actually going to explain what I really mean by that. So this is the representation of overall expected recovery quarterly in absolute numbers for overall economic activity. That horizontal 100 dotted line that you see there is total economic activity at pre-pandemic levels, which was Q4 2019. Now, this is another good way for companies to gauge the level of economic activity for the different countries in their portfolio, rather than just go on the basis of growth numbers, which really don't tell an entirely accurate picture in a year where GDP numbers for countries can range anywhere between negative 11% to positive 3%. Just diving a little deeper into some of the components of GDP here, that's consumer spending and investment are the main drivers or the main components of India's GDP structure. For 2020, basically, we are seeing sharp contractions here, investment actually driving more of the steep contraction. And this is also going to come more from the private investment side as a result of muted business sentiments. And then following that in 2021, you are seeing those growth rates kind of improve. But in terms of overall economic activity, we're not expecting the Indian economy to return to pre-pandemic levels before the year 2022. So now that we've looked at the macro numbers, let's actually get into how the different industry segments have been impacted and what recovery timelines look like. We'll then go into the underlying assumptions for the broader B2C, B2B, and B2G segments. Now, top line here is that timelines for recovery, no matter the level of growth, overall growth in the Indian economy, timelines for recovery across segments differ substantially. The shades of pink indicate demand volumes below pre-pandemic levels, and the shades of green indicate demand volumes above pre-pandemic levels. Orange indicates that the demand level is at a pre-pandemic level. Now, the top 5 segments that you see here are consumer-led or B2C. Now, within this, staples have of course been positively impacted even in the sharpest contraction quarter in India, because more people consume groceries at home, demand for household supplies around cleaning equipment, etc., increased. Non-durables and non-staples, so this would be your apparel and cosmetics, those will recover in early 2021. I would like to highlight here that a spike in demand for these items is likely even in Q4 of 2020. Because that is the festive season of India. So that's October to December of this year, even though it is a pandemic year. Now, during this festive season in India, there are a lot of sales, a lot of discounts that are provided, particularly through these online channels. So there may, some of the companies in this non-durables, non-staple space may see some of that improvement for that brief period of about 3 months due to the festive season. Durables, which are basically here household appliances or white goods, will see an extended period of weakness, primarily because these tend to be your larger ticket items that consumers are currently unwilling to spend on. Again, the Q4 festive season will likely boost short-term sales, but this is likely A, to not sustain, and B, to be at a substantially lower level than seen in years before. Finally, for on-trade sales and tourism, these are two sectors that are basically high contact industries. So these are likely to see prolonged periods of weakness because we do not expect a full recovery in mobility in India until late 2021, which, as you would recall, are exactly aligned with some of our expectations on timelines for vaccination. For on-trade, companies can adapt their product to make it more consumable at home, for example, such as DIY cocktail kits for alcohol beverage companies. Now, the next 5 segments that you see here on the screen pertain to B2B and to some extent B2G segments as well. Overall, our expectations for manufacturing recovery are actually quite subdued. Within manufacturing, we are expecting domestic manufacturing to in fact pick up faster than manufacturing for exports. Now, within construction, we're expecting civil works or basically government-driven construction activity to pick up faster than that for real estate, as infrastructure continues to be a priority area for the government, which they tend to do in order to generate more employment in the country. Automotive, unfortunately, was also performing poorly even prior to the pandemic. So we're, of course, expecting continued weakness here, as this again comes under the larger ticket expenditure item that consumers will likely delay until they see some sort of certainty around pandemic timelines. Next, we have your healthcare companies, healthcare and pharmaceuticals. So, of course, no surprises here that any medical equipment or pharmaceutical company that is directly involved in COVID-19 relief efforts will see very high demand in India through the next 18 months. For companies that are not directly involved in COVID efforts, particularly those that serve elective surgery segments, will actually see a prolonged period of weakness, as the country's healthcare system will be under immense pressure throughout the period of the pandemic. Some over-the-counter pharmaceuticals will recover faster than those devices which are mainly used in hospitals and healthcare centers, which again is directly related to the period of the pandemic and some of that hospital and healthcare center system becoming overwhelmed. Finally, financial services in India will see exacerbated pressure as well. As the pandemic is likely to increase the level of defaults, loan defaults, by individuals and businesses, we are actually likely to see banks become more risk averse in terms of providing credit. Companies with a diversified portfolio can actually use similar color-coded frameworks like this to prioritize some segments that they serve over others in order to maximize revenues during this prolonged period of weakness in the economy. Alternatively, companies that serve multiple end user segments can also use a framework like this to set expectations for the pace of recovery of their customers and prioritize their customers accordingly. Let's now go into some of the underlying assumptions that we track closely that actually feed into some of our expectations for the recovery timelines that you see here and our overarching forecasts that you saw earlier. Now, one of the main drivers behind our expectations of consumer spending is actually driven by our expectations for the unemployment trajectory. Unemployment in India, as with several countries around the world, skyrocketed in the early days of the pandemic, as businesses were suddenly shuttered for a long period of time. While total employment rates have actually normalized, urban unemployment continues to remain elevated in comparison. One note here in terms of the reason or a possible reason why total unemployment rates have actually come down is because the government, it is a government provided minimum wage program that a lot of people have now signed on to, which as a result likely indicates or is like the likely cause for some of these total unemployment levels to come down. However, this is only in the rural areas and it isn't provided in the urban areas as yet. And as a result, that is likely the result of this dichotomy between urban unemployment and total unemployment. Further, on the right-hand side of the slide, as you can see, salaried professionals have actually been among the worst hit due to mass layoffs. As you can see here, 20 million salaried jobs were lost between the months of March and August. Now, while this might improve as time goes on, as businesses start to consolidate some of their financial positions, this position in terms of the level of salary jobs that might come back is actually not expected to be substantial for a prolonged period of time. And so because unemployment and income is so heavily linked to consumer spending, that does feed into some of our forecasts for our overall consumer spending expectations. Now, on the flip side, or in addition to the unemployment prospects, we also have uncertainty around the pandemic that together have hit overall consumer sentiment. What you can see on the slide here are the results of a quarterly survey conducted by the Reserve Bank of India. Current sentiment has certainly taken a hit, and so this is not what we are going to talk about today. However, consumer sentiment over the next 12 months also remains pretty pessimistic. Consumers expect the overall economic situation to worsen over the period of July 2020 to July 2021. Further, a majority of the respondents expected spending on non-essential items to reduce over the same period. So we actually track some of these metrics like unemployment, like consumer sentiment pretty closely because they are actually forward-looking indicators of where consumer spending is likely headed moving forward. Now, let's turn things over to the manufacturing and industrial segment. Here, you can see a chart that indicates the PMI or the Purchasing Managers Index that basically measures the level of manufacturing and services activity in an economy. A PMI reading above the level of 50 indicates an expansion and below 50 indicates a contraction. Now in August, manufacturing activity in fact spiked over the 50 level for the first time in 4 months. Now this is an indication of improved overall manufacturing activity, but it's important to note that the situation in August is much different than that in April through July, in the absence of major lockdowns in August. So the consistent increase in cases will likely actually trigger extended localized lockdowns. And because the recent spike in cases are actually in certain major production hubs around the country, we advise that companies should actually closely track the trajectory of localized outbreaks. So what this really means is not just in terms of total nationwide outbreaks, but localized outbreak numbers that they are seeing maybe around their state, around their district or city. So companies should closely track these localized outbreaks and also track the impact of that on the conditions for workers to return to factories, which might actually be quite difficult for them to do even moving forward because case numbers, as I mentioned, continue to rise throughout the country. Now that was in terms of overall manufacturing activity. Let's now zoom into the various industry verticals. Of course, broad-based, I would mention here that production activity has continued to contract for most segments, and the main reason behind this is extended lockdowns. Now, as you can see, particularly in the March through June period, there were a lot of contractionary numbers here, and probably the sector that picked up the soonest was pharmaceuticals and consumer non-durables. This is actually sustained through to the June and July period. So we are actually expecting this to roughly be similar to the way things are going to be throughout the year 2020. As you would recall, this is also pretty well mirrored with the segment-wise industry color-coded framework that we showed earlier. So pharmaceuticals, consumer non-durables expected to do much, much better than some of the other sectors that you see here. I would highlight in particular, again, in terms of automotive, we're seeing that being a substantial downward contraction here, even in the month of July. We're seeing a substantial downward contractions for consumer durables, as well as certain consumer electronics. Now, a word here on the overall automotive industry or overall production for automotive. We are certainly seeing a dichotomy here in terms of the automotive, in terms of car production and car sales versus some of the lower cost automotive or even two-wheeler sales, which have actually started to slightly pick up recently. So we are seeing some of that dichotomy here as well within the automotive sector, but broadly, we have seen that the sector has actually basically contracted, as you can see from that gray bar here, has basically contracted since almost the start of 2019. So that sector is seeing some substantial weakness here. So that was in terms of overall underlying assumptions and trends from a B2B and a B2C perspective. And again, all of the various indices, sentiment surveys that we've shown throughout are all forward-looking indicators, quite unlike GDP or consumer spending levels that talk about what has already gone by. And so some of these can often be very useful indicators for companies to in fact use in their own expectations or their own assumptions for overall recovery in India. Now things are bad because of the pandemic. I think that is pretty clear. So that's actually when the government usually steps in to provide some kind of additional stimulus to support both businesses and individuals. Now, the Modi government back in March actually did announce a roughly $265 billion stimulus, which roughly translates into 10% of India's overall GDP in 2019. However, upon a closer look, the actual stimulus amount resulting in additional government spending is just about roughly 1 to 1.2% of total stimulus, which is shown by the green portion of this chart. The rest of the 8.8%, which are shown in red and blue, are actually simply just liquidity and monetary policy measures. These are funds earmarked for spending by the government on a need basis. And in that blue bar, we can see monetary measures such as rate cuts by the central bank. Now, these can certainly be useful measures, and by no means is the Indian government the only one that has provided some of this additional liquidity and central bank measures in their overall stimulus packages. However, aside from that, if some of these measures are done in conjunction with or complementary to other substantial measures by the central government in terms of overall spending, in terms of overall stimulus, that would actually result in some kind of a support or assisting the economy to recover into 2021. However, unfortunately for the Indian economy, from the government side, this has actually not happened thus far. Now, the main reason behind this, of course, is government finances are suffering. India's fiscal position is extremely tight. As you can see here from the left-hand side, within the first 4 months of India's fiscal year, that is between the months of April to July itself, the government has hit its deficit target for the entire year. What was meant to be April 20 to March 2021 has now already been exhausted between April 2020 and July 2020 itself. Now, fiscal deficit is basically nothing but government revenues minus its expenditures. And what we really see is that government revenues are the one that has taken a very hard hit as a result of the pandemic. What you can see on the right hand side chart are basically the various sources through which the government gets some of its revenues. So one of the more important ones is the goods and services tax. Now, the goods and services tax, or GST collections, have actually fallen really substantially as businesses basically remain closed for most of Q2 2020 due to the nationwide lockdown. The second one would be in terms of income tax collections, and these have already been low and are likely to continue being low as unemployment has basically surged because of the pandemic, again, as we saw earlier. The central bank also transfers an amount of some of its surplus every year to the government. Now, this year as well, the central bank has certainly transferred some amount, but it was a moderate amount of its surplus compared to what was even budgeted even prior to the pandemic. And then finally, the government also gets some of its revenues from its disinvestment activities. So the government has unfortunately made no progress thus far. Several months into the year, it has made no progress on some of its disinvestment target that it had set at about $28.5 billion. Now, what does this mean for companies? Companies, primarily those that serve the public sector should actually note this. Now, a reduction in revenues this year in 2020 actually means reduced spending, or at least reduced flexibility to spend into the next year. Now, as I roughly mentioned earlier, a key focus of the government will be infrastructure projects and healthcare. However, even within these priority sectors, companies should expect certain payment delays or some ad hoc regulatory changes as a result of overall weakness because of the pandemic. And we'll really go into what we exactly mean by some of these regulatory changes. Now, the Modi government was already becoming increasingly protectionist over its entire tenure since 2015. However, as the pandemic took hold and as certain security tensions with China heightened in June, the government has actually really gotten increasingly protectionist. So as you can see in some of the developments that I've laid out here, like some of the changes to public procurement rules in June, which really required local content sourcing of about 20%. There have also been several restrictions on Chinese inputs and Chinese companies as a result of some of the security tensions that came about in the month of June. Now, at the same time, the Indian government is also trying to wean away from its dependence on Chinese imports, particularly in the sectors of heavy dependence on China, like bulk drug manufacturing and electronics manufacturing. The government, in fact, recently issued certain manufacturing incentives for these specific sectors. Moving forward, we are expecting this trend of increased protectionism, particularly as it pertains to the Indian government's regulations towards China. We're expecting some of this to heighten. Now, what does this mean for companies? This might end up becoming a double-edged sword for several companies. On the one hand, the companies that have a substantial local manufacturing presence is actually expected to gain from some of this increased protectionism or increased government favor towards local companies as a result of some of the ad hoc regulatory changes that we are expecting the government to put into play moving forward. However, alternatively, even if a company is to a large extent manufacturing within India, as we've also heard from some of the clients that we serve, some of the crackdown or the clamp down on Chinese imports and imports have actually caused some pain to them. So this really looks like certain increase in import duties, increase in import bans, or border checks for some of the Chinese imports that's actually going to create some of the added costs to a company that is probably importing some of these inputs, even though they are manufacturing within India. So this is a dual-edged sword that really provides definitely a substantial opportunity for companies that are already pretty heavily localized. And on the other hand, it's also a word of caution here for a lot of companies to really examine their own supply chain, examine where some of their products are coming from, and the relative exposure to some of the Chinese inputs. So we'll actually take a pause here, and I'd like to, in fact, pose a question to the audience in terms of the extent to which your business has been impacted by the government's protectionist measures. So we'll wait for just a couple of more seconds for more respondents to answer. You could just click on the device that you're listening to the webinar on. All right. So as we can see here, roughly 56% of total respondents said that there is a negative impact. However, some of this impact is limited. So certainly in terms of the negative portion of that answer, that kind of pretty much well aligns with what some of our expectations were. Some of the respondents, so that's roughly 20%, have also responded saying that there is a limited positive impact here, which again kind of shows some of this double-edged sword nature of the way that we kind of expected things to go. In terms of the companies that responded that there is that some of the impact is on the negative side of things. So certainly, it is unfortunate that that some of these localization pressures have caused some of that negative impact. We do expect some of this protectionism or enhanced favor towards local companies to increase, and so this would be a good time to have some of those conversations with the suppliers, with your local teams, to really understand what that exposure is to overall imports from China. And so now that we've had a look at the different industry trends and what the expectations from some of the government behavior is like, we'll now go into a deep dive on India's state-wise trends. Now, India is really a country of countries, so looking at the way that the different states are likely to behave beyond just some of those national level numbers is actually going to be quite critical. So first, we'll look at what's happening around the pandemic. Really what you can see here is that large number of large national numbers or case counts of COVID-19 are actually driven by the largest economic hubs in India. Just 6 states out of 28 in total make up 90% of total active cases here. Really, these are the states that are the largest either consumer or industrial hubs. Some of this is, of course, Delhi, Maharashtra, Tamil Nadu, Karnataka, as well as Andhra Pradesh. Now, not only are some of these larger states, larger consumer and industrial hubs, the ones that are contributing to some of the increase in case counts, but also what we're noticing is that the patterns of some of these new outbreaks across the country have also been evolving pretty substantially over a period of 2 months. So as you can see on the left-hand side here, these are the contribution of different states to new COVID-19 cases as of end June. So there what we really saw was Maharashtra, Tamil Nadu, and Delhi were the ones that were contributing the largest amounts. And again, these are some of the largest states. But then as we moved into a few months into the pandemic, what we actually saw was that Karnataka, a state that we really thought previously had the pandemic under control, as well as Andhra Pradesh, have now emerged as new virus hotspots. Delhi actually also saw a temporary period of containment, but this optimism was relatively short-lived because we are now seeing another resurgence or a second wave, if you will, in Delhi as well. What this really tells us is that sure, certainly, if there is a state that has been relatively successful in keeping the pandemic under control over a short period of time, this is likely to not sustain. It is likely that, particularly if the state is relatively large, if the population density tends to be relatively large, then it is likely that some of those states may end up seeing a new wave of outbreaks. And again, what we're really seeing here is almost exactly perfectly mapped onto what we saw on the previous slide in terms of some of the states that are contributing more to new COVID case counts. What this slide really shows is the footfall or the foot traffic at certain retail outlets compared to a baseline period over 5-week period between Jan 3rd to February 6th. So this is again that pre-pandemic period. Again, these are all of the major states: Maharashtra, Delhi, Karnataka, Tamil Nadu, Gujarat, Andhra Pradesh, and Kerala. Across all of these states, we are still seeing, even several months into the pandemic, anywhere between a negative 30% to negative 50% levels of overall footfall in some of these retail outlets, even several months into the pandemic. And now, so basically, due to the divergence of the level of outbreaks across the different states, we're actually seeing that some of the major states that tend to be some of the bright spots in India's overall economic growth story, which are also the major consumer industrial hubs, will likely see sharp contractions in growth numbers in the year 2020. Again, some of the names are familiar here. We have Maharashtra, Tamil Nadu, Delhi, West Bengal, Gujarat, and Karnataka. We expect steep double-digit contractions in all of these states because either there is a high proportion or contribution of manufacturing or services activity as opposed to agriculture, or there are certain recent reports that have indicated that pandemic numbers in some of these states are on the incline. Now, there are some states that have been hit by the pandemic, but not as hard as others. Those are the likes of Rajasthan, Chandigarh, Punjab, Odisha, and Kerala that you can see on your screen here, which are not often some of the major states. And so some of these are going to contract less than the others. Now, companies should consider expanding their sales to some of these states in the near term, in order to make up for some of the shortfall that they are likely to experience in some of the other states where maybe they traditionally have more of a presence in. Now, moving on from some of that impact in 2020 on to 2021 and beyond, this chart shows our expectations of the level of impact from the COVID-19 outbreak on the economy as a whole, so on the economy of the different states and on their government finances. Now, for some of the states that are highly exposed to the pandemic due to high population density or that are highly dependent on tourism, like Goa, for example, some of these states are going to see a steeper contraction than some of the others. The economic outlook and recovery for some of the larger states that we did see previously, such as Karnataka, Maharashtra, and Delhi, are actually likely to somewhat recover in 2021. And the main reason behind this is because a large part of the population in some of these states actually tend to have, say, better digital home infrastructure, which allows them to perform jobs even from the comfort of their homes. Additionally, a sizable portion of the economies of these states is actually made up of the IT services. So this sector has actually performed relatively well during the pandemic and is only expected to boom moving forward. Now, moving on to the impact of the pandemic, of some of the disruptions of the pandemic on government finances. Now, just as we saw with the central government finances, the pandemic has also put a heavy strain on the resources of certain state governments. Now, states that depend heavily on, most of the states here actually depend heavily on the central government for a certain share of the goods and services taxes on certain grants, and then also a part of their own revenues, which come through direct taxes and excise duties on alcohol and fuel. And so what we're really seeing here is that, yes, there is going to be a large impact here on the government finances of nearly all of the states. But some of the governments tend to manage their finances better. They were also in a better fiscal position going into this pandemic. And so those are really the ones that are going to see relatively no impact that you see in the gray boxes shaded there into 2021 and 2022. Now, before we close out the outlook for India section, we'd also like to put out this additional polling question to the audience. So what we really wanted to understand here is, based on whatever we've seen today, some of your own expectations, do you expect big changes to India's prioritization in your APAC portfolio as a result of the pandemic? Thank you for your responses. Now, here we're actually seeing that most of the companies are actually likely to see no changes to India's overall position in the APAC portfolio, which is actually an interesting and a good note here. So what we've also heard from a lot of the companies are that yes, a lot of their expectations around the very deep impact to India's economy in 2020 and 21 are roughly aligned with what we've shared today. But really, some of them, a lot of the companies here, are actually betting on some of the medium to long term continued growth that we're expecting to see in the country. And so some of the polling results are actually likely reflective of that. And then there was a small percentage of the respondents that also talked about planning to deprioritize India over the next 12 months. And so that actually makes a lot of sense because in the medium term, I assume that that some of these companies plan to maybe prioritize some of the other countries in their APAC portfolio that are likely to do somewhat better in this pandemic situation. So now we will just move to the next section of this presentation. We'll switch gears over to India's neighbor, Pakistan. We'll just take a few minutes here to talk about Pakistan's economic outlook. Now, as you can see here, the Pakistan story actually looks pretty different. As we saw several slides ago, the COVID-19 outbreak in Pakistan was quite drastic in the June to July months. However, of late, there has been a marked improvement in COVID-19 containment in the country. We do continue to watch what this outbreak really looks like. The Pakistan government has basically all but removed all restrictions on overall mobility. But so we are expecting that some of the rises in case counts are likely to come back. So we will continue to watch that. And again, this will go into some of our forecasting assumptions. The second thing that we're watching is government containment measures, of course. And then finally, any additional international financial assistance that the Pakistan government tends to be pretty heavily reliant on. Basically, overall, we are expecting a somewhat contraction in the year 2020, followed by a recovery in 2021 and 22. Some of the drivers behind this outlook are basically a relatively positive driver from overall investment, consumer spending, as well as external trade. And again, government spending here, it's a similar story in terms of limited government finances. So we are expecting that to have a neutral impact on overall economic growth. Now, this chart is really telling in terms of how our assumptions really have changed from March into June, and then certainly in the current month in September. So actually back in March, most of South Asia was relatively less impacted by the outbreak. And so we were expecting a decent amount of growth from the Pakistan economy. Shortly after that, we significantly revised down our growth forecasts because around the June to July period, when it really seemed like things were starting to pick up, when cases were starting to increase in Pakistan, we did revise some of those numbers. And then most recently, because enough time has now passed since the new COVID-19 cases are showing low numbers here, we are actually expecting somewhat of a growth into 2021 for Pakistan. Again, just like I did for India, I would like to provide a note here that 2021 here really refers to Pakistan's financial year, which runs from July 2020 into June 2021. And so this is really something that I have been talking about. We were seeing extreme spikes after the nationwide lockdown was lifted. And so we really expected this to continue. But some of the cases, the new case counts have actually come down, trickled substantially in the recent months. And so we are expecting that as a result of this improvement in the level of outbreak containment in Pakistan, it's unlikely that any stricter lockdowns are going to be put in place. So what this would really mean in terms of mobility is that mobility not only has increased to a large extent, but it's also likely to continue to remain at these elevated levels. What all of this really means is it has improved our expectations on overall consumer spending. So again, this chart really shows the foot traffic in certain retail outlets compared to a baseline period of Jan 3rd to Feb 6th. And so what we've really seen in some of the, in fact, in nearly all of the major metropolitan areas in Pakistan have now seen a positive growth in overall retail footfall here. And so that really drives some of our improvements and expectations from consumer spending. However, a note of caution here. So Pakistan's overall testing rates really remain among the lowest globally. One of the few countries that test even less than Pakistan is Bangladesh. But apart from that, Pakistan really lies on the far right end of overall testing rates per 1,000 population. So what this means is some of those case counts that we saw, that doesn't really give us the full picture of what may be going on with Pakistan's overall case count numbers. It's entirely likely that the case counts continue to show this positive trajectory, and so that would be really good news. However, some of the lack of testing could also mean that it is hiding a much larger outbreak that's actually taken place in the country. Moving on to some of our expectations from overall inflation and then exchange rate. We are expecting headline inflation in Pakistan to pretty much remain elevated throughout the year 2020 as well as 21. And the two main reasons behind this are large amounts of increase in food and beverage prices, and this is mostly a result of widespread crop destruction as a result of some of the locust infestations that had started early on in the year. And then the second one is in terms of hikes in fuel prices. So both of these factors combined will increase some of the food and the fuel costs well into 2020 as well as 2021. So for the year 2020, we're expecting overall inflation to be at around 10%. And then finally, some good news coming in from the Pakistan rupee. After a period of substantial depreciation, really since the start of Jan 2019, the rupee is finally likely to stabilize through the rest of 2020. And the main reason behind this is really our improved outlook on the overall economy. But as I said, we continue to watch what's going on in the economy, how COVID-19 cases continue to perform, as well as what the government does with it. And so that any changes in those will also change our outlook for the overall Pakistan rupee. Aside from that, of course, oil prices or international oil prices have remained subdued. And so that's causing some amount of strengthening for the Pakistan rupee. However, risks, of course, still remain. There was a period of large-scale capital flight as a result of overall global uncertainty. There is also the issue of a potential increase in the current account deficit that could likely put certain depreciation pressures. Now, that's all for the Pakistan story. With that, I'd like to pass things on to Raveen.
Outstanding insights. Thank you, Kinnari. I know we've reached the hour mark, but we'll spend a couple of minutes just to begin the Q&A portion of the webinar. So if you have any questions, please share them with us via the GoToMeeting messenger by sending your questions to Dhaka Frontier Webinars. And in fact, we've been receiving a lot of questions over the past couple of minutes, and I think we may have time for just one final question. Kinnari, it will be interesting to hear your thoughts on this one. And this is particularly related to some of the insights you brought up around consumption and also consumer behavior. In fact, we have one question around any changes in consumer behavior in India due to the pandemic that we can perhaps highlight.
Okay. Yeah, great. That is actually a really interesting question, and we are in fact seeing certain substantial changes in consumer behavior because of the pandemic, even around over and above a lot of this doom and gloom generally as it pertains to consumer spending. Um, so I would say there are basically two things that companies should look out for in terms of consumer trajectory. The first one would be in terms of consumer behavior or affinity more towards health and wellness. So a lot of the consumers are now increasingly looking out for labels that have, say, organic or healthy attached to it, and there's a lot of kind of self-care move towards self-care that is really going on. So whether this is even in terms of say cosmetics companies, FMCG. So for example, for cosmetics companies, this would really mean a sharp spike or a more of an affinity towards say skincare rather than cosmetics. For some of the other FMCG companies, there's a lot of movement towards brand transparency and also overall health and wellness. So that would be one. And the second one, that's a really interesting trend and certainly is something that we're going to see accelerated because of the pandemic. That is the move to the online channel. This was already happening in India, and there's a really large market, highly unpenetrated in terms of internet services or consumers basically buying things online, e-commerce. But because of the pandemic and the restrictions to overall mobility, we have really seen that this has forced almost many consumers to move to the online channel. And now that they've done that for a long period of time, we are expecting this to kind of be basically a very long-term trend. So this is something that companies should really look out for, should really address in terms of maybe improving some of the digital capabilities of, say, their sales teams, of their local distributors, and to create almost a seamless omni-channel experience for the consumers and for customers.
Thanks, Kinnari, for that fantastic insight on the consumption side of things in India. All right, we're nearing our time limit for today's webinar. If there were any questions that we were unable to answer on the line today, we'll be sure to follow up with responses through your relationship manager. Before we conclude, Kinnari, do you have any final remarks to share before we wrap up the session?
Sure. Thanks, Raveen. So we'd like to finish this webinar by highlighting certain key takeaways that we outlined throughout the session. So the first important thing would be to definitely align with local teams on the expected timelines for economic recovery and demand recovery for your specific segment. The second would be to engage with government officials in order to get ahead of any potential disruptions due to any changes in lockdown restrictions that we are expecting moving forward, particularly in India. The third is to pressure test your India subnational or state level portfolio and to target certain specific states and cities with the most opportunity. And then lastly, for companies that are operating in India, we expect heightened protectionist measures, particularly towards certain Chinese imports or inputs. And so companies should certainly assess the exposure to some of the Chinese imports and develop contingency plans in case trade tensions further escalate.
Thanks for rounding out the session, Kinnari. That concludes our webinar for today. Thank you everyone on the line for joining us. We look forward to speaking with you again very soon. Have a great day ahead.